If you are thinking about buying your first rental property, this video is for you. You've heard that real estate creates wealth, but how does it actually work? And in this video, I'm gonna go over the details and you'll see why real estate has created more millionaires than just about anything else. And please be sure to share this with anyone considering buying an investment property. Now, most who buy a residential investment property will put down 20% on a conventional loan. Some opt for a 15-year, but others do a 30-year. For this video, we'll use a 30-year loan for the examples. Now, the first way real estate makes you money is from cash flow. So cash flow means more rent is coming in than your payment and expenses. If you are collecting $2,500 in rent and your monthly payment is $2,000, you have a cash flow of $500 per month. Now, when you first buy a rental property, it may not cash flow immediately. Now, some do depending on the price of the home and the rents in your area, but oftentimes it might not at first. Now, this changes drastically over time. Let's look at this particular house that is currently available in the Salt Lake market. It's currently listed for about $450,000, and the rent estimate is $2,381. So if you're looking for a property, you want to ask your agent what the estimate is for the rent in your area. Websites like this aren't always accurate with this sort of information. We're gonna use it for right now, but just keep in mind it's not always accurate. So if you bought this home for $450,000 and you put down 20%, you'd have a loan amount of $360,000. Now, depending on what the taxes and insurance is, your payment would be somewhere around $2,600 total. I'm gonna use an interest rate of 7% for these calculations, so depending on when you buy and your credit score, your rate might be higher or lower than this. Now, the rent estimate is roughly $2,400. That means in your first year, you'll have some negative cash flow of about $200 per month. But hold on. Let's look at how this changes over time. So on average, rent increases about 5% per year, but we'll use a 3% average increase for our scenario. Your mortgage payment will increase slightly too, and that's just due to taxes and insurance increasing every year. So even if the principal and interest stays the same, taxes and insurance tends to go up a little bit each year. So over the course of 10 years, you end up about $1,000 ahead on cash flow. With this scenario, you'd likely refinance as rates go down, but we'll stick with these numbers for now. So as each of those payments were made, a portion of that payment went to pay down the mortgage. Now remember, your payment has principal, interest, taxes, and insurance in it. So the principal portion is paying down the balance of the loan. So that negative cash flow doesn't seem so bad now, right? In year one, when you were putting $200 towards the negative cash flow, $295 of that was actually going towards the balance. So you kind of had a forced savings plan. It's kind of like taking money out of one pocket and putting it into another, and this other pocket is called equity. Now, during this 10 years, you'll pay down the mortgage a little over $51,000 from just making the payment. But wait, there's more. Most investors will depreciate the property on their tax returns. Now, this is when you deduct the cost of buying and improving the property over its useful life, which is typically 27.5 years. Accountants can deal with that part, but that's how it works. For this calculation, you can include the cost of the house, but not the land. So for the home that is $450,000, you may deduct around $13,000 or so for what's called depreciation. And this will be each year. So if you're in the 22% tax bracket, that puts $2,860 back in your pocket every year until you depreciate it completely. So over 10 years, we have roughly, this is so far, $1,000 from cash flow. We have $51,000 in principal payments, right? And then we have $28,600 in tax savings. But wait, there's more. After that is the biggest portion of wealth creation, and that is the property appreciation. The average home appreciation for the last 3 decades is 4.4% per year. So that means this home that is $450,000 now will be $692,000 after 10 years. Now, there could be some market fluctuations that make it higher or lower at the end of that. This is just the overall average where it tends to be. Now, this would give us a total of $1,000 from cash flow, $51,000 principal payments, $28,600 for tax savings, and $242,000 for property appreciation. Total, $322,600. Not too shabby, right? But there are some important things that you need to consider. And there are some things that can affect this total. So one is if you have a major repair during the 10 years you own it. So for this, I'd like to buy homes that are maybe a little bit newer so I can avoid having some major repairs. Number 2 is if you have long-term vacancies. So what that means is if you have a long stretch of period of time where the house is vacant and there aren't any renters. I've never experienced that in my rental properties. I've usually only had like 1 month. On average, in the US, you'll have 1 month vacancy every 20 months. There are also some things that you can do to maximize your net worth increase during this time. You can find homes in an area where rents are higher relative to the price of the home. This can make it so you can cash flow a little bit faster, right? You can also pick an up and coming area, and if it ends up being very desirable over that 10 years, the value of that can increase much more than what the national average is. Once you get some cash flow going, you can put that extra money back along with your tax savings into the mortgage to pay it down faster. This will reduce the overall interest as well because mortgages are simple interest. Now, another thing that you might be considering is how this could play out if values were to drop. Now, this video right here will tell you about a property that I bought just before the 2008 crash and how it worked out. So I hope you found this video helpful. Please be sure to like and subscribe, and we'll see you on the next one.